What if you could learn directly from the man who turned $100 into over $21 million in a single lifetime? That man is Warren Buffett, often called the Oracle of Omaha. For decades, Buffett has outperformed Wall Street, crushed hedge funds, and built Berkshire Hathaway into a global empire worth over $900 billion. His secret? It's not a magic formula. It's not insider trading. It's a simple set of investing principles. Timeless rules that anyone can understand, but very few have the discipline to follow. Buffett himself says, "I don't look to jump over 7-foot bars. I look for 1-foot bars I can step over." That's exactly what makes his strategy so powerful. It's simple, not easy. In today's video, we're breaking down the 6 investing principles that shaped Warren Buffett's fortune. We'll cover not just what they mean, but also real examples of how Buffett used them, and how you can apply them to your own financial decisions. So grab a notebook, because this could be the most valuable lesson in money you hear all year. Principle number 1. Cash is not king. Buffett has a controversial saying, "Cash is always a bad investment." That shocks people because most of us are taught to save money in the bank. But here's the truth. Cash loses value every single year because of inflation. $100 today won't buy the same groceries next year. Buffett compares cash to oxygen. You need a little to breathe, but holding too much of it suffocates your wealth. Example: in the 1970s, inflation in the U.S. hit double digits. Anyone holding cash watched their purchasing power collapse. But Buffett invested in businesses that raised prices with inflation, like Coca-Cola and newspapers. Those investments grew, while cash savers lost out. Lesson for us: build an emergency fund, yes. But after that, don't let your money rot in a savings account. Put it into assets, stocks, real estate, or businesses that generate returns and beat inflation. Principle number 2. Own productive assets. Buffett despises assets that just sit there. He's not impressed by gold, Bitcoin, or collectibles that depend solely on someone paying more for them later. Instead, he focuses on productive assets, things that create value. He once said, "If you own 1 ounce of gold for an eternity, you still own 1 ounce of gold. It doesn't produce anything. But farmland? It produces crops every year. A business? It earns profits. Stocks? They represent ownership in businesses producing goods and services." Example: Buffett famously bought a Nebraska farm in 1986. He never worried about its daily price. He only cared that it produced crops year after year. Decades later, it's worth far more, not because of speculation, but because of productivity. Lesson for us: invest in things that work for you even while you sleep. Businesses, rental properties, dividend stocks, or skills that produce income. Principle number 3. Stay in your circle of competence. Buffett often says, you don't have to be an expert on everything, but know your limits. This is what he calls the circle of competence. If you don't understand an industry, don't throw your money at it just because it's trending. Example: during the dot-com bubble of the late 1990s, everyone was chasing tech stocks. Buffett stayed away, admitting he didn't understand internet businesses at the time. People mocked him for being old-fashioned. But when the bubble burst in 2000, wiping out trillions, Buffett stood firm. Lesson for us: don't invest in hype. Focus on what you truly understand, whether that's real estate, blue-chip companies, or a business you know inside out. Principle number 4. Value the business, not the stock price. This is perhaps Buffett's most famous principle. Stocks are not just numbers on a screen. They are ownership in real businesses. Most investors get trapped by daily price swings. Buffett ignores them. Instead, he looks at earnings power, assets owned, future prospects. If the business is solid and the stock price is way below its real value, he buys. Example: in the early 2000s, Buffett bought PetroChina after reading its annual report. He valued the company at around $100 billion, but the market priced it at $20 billion. That's a massive gap, so he invested. Later, the stock quadrupled, and Buffett sold at a huge profit. Lesson for us: think like a business owner. Would you buy the whole company at its current price? If yes, that's a good investment. Principle. Number 5. Go big on rare opportunities. Buffett doesn't believe in spreading himself too thin. He says opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. He uses the 20 punch card rule. Imagine you could only make 20 investment decisions in your entire life. You'd think carefully, act decisively, and go big when the odds were heavily in your favor. Example. In 2008, during the financial crisis, Buffett invested billions in Goldman Sachs and Bank of America when fear was at its peak. Those deals paid off massively once the economy recovered. Lesson for us: don't waste money on dozens of random bets. Save your resources for the rare, once-in-a-decade opportunities, then strike hard. Principle number 6. Invest in yourself first. Buffett's most important advice isn't about stocks at all. It's about you. He says the best investment you can make is in yourself. Your skills, knowledge, and character are assets that compound forever. Unlike money, they can't be taken away, inflated away, or taxed heavily. Example. Buffett once took a public speaking course early in his career because he knew communication was critical for business. That small decision paid off in countless ways, helping him persuade investors, negotiate deals, and inspire confidence. Lesson for us: read, learn, practice. The more you improve yourself, the higher your earning power and the better your financial decisions. Conclusion. So, let's recap Warren Buffett's 6 timeless investing principles. 1. Don't let cash sit idle. 2. Own productive assets. 3. Stay within your circle of competence. 4. Value the business, not the stock price. 5. Go big on rare opportunities. 6. Invest in yourself first. These aren't quick hacks or get-rich-quick tricks. They're long-term rules that built one of the greatest fortunes in history. At the Real Estate Scouts, we share insights like these to help you make smarter financial moves in today's unpredictable world. Which of these Buffett principles do you think is most important in today's economy? Drop your answer in the comments. I'd love to hear your perspective. And if you found this video valuable, make sure to like, subscribe, and hit that bell for more wealth-building strategies. Thanks for watching. See you in the next one.